welcome to Theo Trade. This is Don Kaufman. April 12th, 2021, minutes after the cash close here on this Monday afternoon. Hell, once again, the marketplace finishing, for the most part, massively unchanged. Nevertheless, we do have bank earnings right around the corner, and they very well could shock the marketplace. Let me get into some depth of exactly why I'm actually saying that. First and foremost, taking a look at the broader marketplace, well, there's not much to look at, right? Not exactly, again, an awe-inspiring trading session. The S&Ps today, they did 1 million contracts. But I'm actually going to jump right down right now to the bond market. The bond market still doing some serious size, okay? And the bonds, well, the bonds had everything. They literally have everything to do with the financials, okay? At this point in the game, the bonds, they're just nowhere to be found. But again, they're still pumping some fairly decent volume and size trade. One of the things outside of earnings, and again, before we actually dig into the earnings and earnings announcements that are coming here, one of the first things that we want to kind of focus on, this bond market trading in an incredibly tight range, okay? If the bonds persist inside of this incredibly tight range, sure, earnings are going to grip hold, and the S&Ps a little higher, a little lower based on some of the earnings and earnings announcements. But I'll kind of, defer to the fact that I believe the next major move is coming out of the bond market. And it's exactly why I'm actually covering it. If the bonds kind of progress slightly higher here, okay, it's going to effectively take interest rates down, and it's going to hurt some of the financials. Now, okay, we're not worrying about earnings just yet. All right. If those bonds turn around and start to see some sell side activity, that will actually take rates a little bit higher. Okay. And probably, and again, if this would be a pretty significant sell off inside of the ZB, that would actually impact then none other than the monsters of tech. That's where you actually see tech start to go into a little bit of a tailspin. So there's kind of a catch-22 going on specifically inside of the bond trade. The bonds, again, they look prime right now to break the range. And, what do I see inside of the bond product that leads me to believe that this is the case? And if you cruise over to the TLT, I think it's the easiest way to justify to see this. Cruise over to studies. We're actually going to go to add study and cruise up to implied volatility. So how the option market kind of denotes risk. Now, risk, it's upticking ever so slightly right now with the bond market inherently flat. Nevertheless, if you actually look back still over the last 3 years, we are still, okay, in kind of this COVID volatility inside of the bond market. Whereas at the exact same time, I mean, the VIX has dropped all the way back to like some of the pre-kind of COVID levels. Again, bond volatility is a different animal, and it's one of the reasons bond volatility remains fairly significant. Speaking of which, I have actually maintained and continue to maintain a decent-sized inventory of some bond options that I've actually sold, and I'm still selling premium inside of the bond product because the volatility has held up. Now, okay, with that kind of in scope, we do and are entering into the period of earnings, okay? And the reason I want to put this into scope, and again, I wanted to give you kind of my feelings on the bonds. The bonds, if they trade outside that range, okay, I don't see too many areas that are going to be that positive for the marketplace. Why? If you take a look at the financials, once again, they're hitting highs in here, okay? These financials are what really initially led to the S&P in the rally. Right? In fact, if you take a look at this and compare like the S&Ps, and we'll just cruise over to the XLF for a second, the XLF, again, seeing a substantial rally, was actually dragging the spiders up, kind of kicking and screaming earlier on in the year. What I'm referencing really specifically is pretty much from the first of the year, okay, until the time frame, and again, I'm just going to detail this so everybody can see it, to the time frame here of kind of late March, all right, and then all of a sudden, right, it's tech that actually kicked into high gear and broke the spiders out to all-time highs. And again, if you want to take a quick glance, you can actually bring up specifically the monsters of tech. That line that was on the screen over there was the S&Ps. Okay, monsters of tech were nowhere to be found. It's the monsters of tech that, well, pretty much in the last 3 weeks have actually dragged us into all-time high territory. Now, for the S&Ps to continue, okay, to kind of progress to the upside, once again, I think you have to have the financials in play, and this is where earnings are going to come in a big way. All right, if you look at this and some of the earnings announcements, some of the bigger ones, and the two that I'm going to focus on predominantly, I'm going to focus on Goldman Sachs. Okay, Goldman Sachs obviously can move markets to some degree. It's not exactly the largest market capitalization. Take a quick glance at market cap here. In terms of market cap, you're a $100 billion company. Nevertheless, okay, it is a little bit of like a litmus test for the entire marketplace. And of course, they're coming out with earnings on Wednesday morning. Alongside of that, and again, a little bit of a heavier weight in terms of market cap would be JP Morgan. JP Morgan coming out, of course, at the exact same time. Now, one of the things that I was saying here in just a moment ago was like, hey, will bank, earnings kind of shock the marketplace? Recognize that statement is not necessarily to pretend that's going to be bearish. Okay, the shock to the marketplace, as I showed you, if the financials continue to chug to the upside, it's actually going to continue to have this big gamma squeeze inside of the S&Ps. Nevertheless, okay, one of the things that kind of resonates with me, the volatility here in JP Morgan, and I'll start with JP Morgan. Okay, it's almost non-existent. They're actually showing that the bank earnings are very well priced into the marketplace. And again, you're not seeing much differentiation in these 4-day options versus these 11-day options with a $5 expected move. And that's why I think that there's actually opportunity at this point in the game to actually shock the marketplace. Why? Because the volatility is inherently low. Now, again, most of the time, the bank earnings do have rather low implied volatility, right? There's not much of a surprise to see this. Nevertheless, okay, there are a lot of question marks around some of the events that have occurred, literally with the fund blowing up a few weeks ago, right? Obviously, JP Morgan may not necessarily have exposure, but somebody like Goldman Sachs absolutely could. The other aspect, and I think they're going to get questioned by a lot of the analysts during the bank earnings, okay, what else lies inside of the closet there, right? There could be some skeletons in the closet for Goldman Sachs. They're probably going to relinquish anything, okay, that looks remotely risky in terms of their portfolios. So you can actually see that a little bit more of a deviation inside of Goldman Sachs. And that's exactly what I'm referencing in this particular case, is that Goldman Sachs, again, all right, packs a little bit more of a punch in terms of the earnings around the announcement of a $13 move on a $331 product, okay? What we're actually going to look for in the case of these earnings are moves right to the edges of the expected move, and even the occasional surprise outside the expected move. Okay, so in effort to explain this in terms of like trades and what type of trade that you may want to actually embark upon, first of all, think about defined risk. Think about defined risk. Okay, the other aspect in here, volatility has actually come down quite considerably. And again, this is where I actually see a little bit of edge in earnings. A moment ago, I was actually talking about bond volatility seems fairly high. But when you start looking at stuff like Goldman Sachs, all right, come down to volatility studies, cruise up to implied volatility. Look how low the implied volatility. That's 30-day implied volatility is rock bottom. Okay, the point that I wanted to make with this, people look at like earnings like, yeah, man, I'm going to go out and sell that premium. I'm looking at the exact opposite. I'd be a buyer of premium. Okay, why not take the shot to the outside? Instead of selling an iron condor, buy the edge of the expected move. That's an iron condor wrapped around like a $13 move higher or a $13 move lower. Buy the outside of the expected move and hope that literally Goldman Sachs rocks the marketplace, has a couple of skeletons in their risk closet, and you'll be fairly well compensated for doing so at this point in time. Again, the marketplace right now appears to be pricing in earnings, and it's an incredibly efficient time. Like, I don't want to tell you, oh, the marketplace is wrong, okay? But when you start looking at things like visually, like looking at implied volatility, even open this up over like the last 3 years, okay? I mean, that volatility is one of the lowest points it's been since the onset of COVID, and yet you would think at this point in time they probably have considerable amounts of risk. If there's any unforeseen risk in here, you're going to rock well past that $13 move. Same goes for, again, many of the bank earnings. As I said, I think there's some skeletons in the closet over here, and some of that may actually be relinquished later this week. Thanks, everybody, for joining us here at Theo Trade. Have a wonderful evening. Bye-bye.